Imagine you're driving down the highway, maybe going, I don't know, 10 or 15 miles over the speed limit.
Right, just keeping up with traffic.
Yeah, exactly. And a police officer pulls you over. You roll down the window, you're, expecting a $100 speeding ticket.
Which is annoying, but, you pay it.
Right. But instead, the officer hands you the citation, and the judge doesn't just ask for $100. They look at your entire financial portfolio.
Oh, wow.
Yeah. Your 401k, your savings, your equity, and they just seize exactly 10% of everything you own.
I mean, that sounds like a dystopian novel, like a punishment that just completely divorces itself from the crime.
Right.
It just scales infinitely with your wealth.
It really does. But see, if you're a multinational corporation operating in the United States, that isn't dystopian fiction at all. That's a very real, very terrifying mathematical reality, hiding deep within the United States tax code.
Yeah, it's wild.
If you leave a single line blank on a form you might have, never even heard of, or if you accidentally net two numbers together that were supposed to be kept separate, the Internal Revenue Service can trigger exactly that kind of penalty.
Just an absolute hammer.
Literally. They can wipe out 10% or even more, actually, of your global foreign tax credits, which is a move that routinely costs companies hundreds of millions of dollars in hard cash.
And the crazy part is, the form that holds this kind of explosive power isn't even the primary corporate tax return itself. It's an informational schedule attached to it.
Right. And usually, when we talk about a diagnostic tool, let's say an X-ray in medicine, there's this expectation of clean precision.
Sure.
You break your arm, the X-ray shows a jagged white line, and the doctor just points and says, there it is, broken.
Yeah, we like things to be visible and binary, easily categorized.
Exactly. We want the data to just hand us the answer. But when you step into the world of multinational corporate taxation, the X-ray machine doesn't just show the bones. It shows like the blood flow, the nervous system, the genetic history, and the exact caloric intake of the patient for the last 3 years, all layered on top of each other.
It's the absolute definition of diagnostic muddy waters. I mean, the IRS knows that a simple snapshot of a company's financial health is practically useless when you're dealing with a global entity that has subsidiaries in, 40 different countries.
Right, because a static balance sheet doesn't catch profit shifting.
Exactly. So they demand a financial MRI.
Which brings us to today. Welcome back to another tailored deep dive. Today, we are unpacking the complex, incredibly high-stakes world of related party transactions.
This is a big one for anyone tuning in.
It really is. Our lens for this mission. A digital file that strikes absolute fear into the hearts of corporate controllers and tax directors everywhere. The Internal Revenue Service Form 5471, and specifically, the related party matrix known as Schedule M.
And calling it a matrix is really the most accurate way to describe it. It's not just a list of expenses.
Definitely not. If you're listening to this right now and you work in corporate accounting, you probably just shuddered at the mention of Form 54701.
Oh, yeah, for sure.
But even if you aren't an accountant, if you're just someone insanely curious about how governments actually police the flow of trillions of dollars across international borders, this deep dive is going to serve as your ultimate insider's shortcut.
We've got a lot to cover.
We really do. We're looking at a stack of heavy-hitting source material today. We've got the Internal Revenue Manual's penalty handbooks. We have Treasury regulations under Section 6038 and Section 6038 Cap A.
The real nuts and bolts.
Yep. And we have the meticulous, almost overwhelmingly detailed instructions for Form 5471 itself, spanning Schedules M, G, and G1.
And what becomes immediately apparent, when you read those instructions, is that the IRS isn't asking these questions just for the sake of bookkeeping. When the IRS looks at Schedule M, they're hunting.
Hunting for what exactly?
They're looking for hidden value transfers. They're mapping the exact pressure points where a U.S. parent company might be artificially shifting its domestic profits to a subsidiary in a low-tax jurisdiction.
Right.
Or where they might be eroding the U.S. tax base by overpaying a foreign affiliate for, routine services. Schedule M is basically the tripwire for the most massive transfer pricing audits in the world.
Okay, so before we can even talk about the transactions, the actual money moving back and forth, we have to figure out who is actually in the room.
Right, setting the stage.
Because the IRS doesn't care if a U.S. corporation buys $1 million worth of coffee beans from an independent farmer in Colombia, right? That's just a regular business expense.
Exactly. They care when the money stays within the corporate family.
So let's establish the cast of characters. Who is actually required to file this form?
So the primary entity the source material focuses on is what the IRS defines as a Category 4 filer of Form 5471.
Which immediately makes me wonder what happened to categories 1, 2, and 3.
Right. It's a whole alphabet soup.
But we'll stay focused. What defines a Category 4 filer?
The trigger for Category 4 is control. Specifically, a U.S. person who has control of a foreign corporation during the annual accounting period. And, U.S. person is a broad umbrella.
So it's not just citizens.
Oh, no. It covers U.S. citizens, resident aliens, domestic partnerships, domestic corporations, and even certain domestic estates or trusts. If any of those persons have control over a foreign entity, they're on the hook.
Okay, control is one of those words that sounds so simple in plain English, but is a total landmine in tax law. If I'm looking at Section 6038, how is the IRS actually defining control? Because it can't just be about who sits in the big chair in the boardroom.
No, it's a two-pronged test. Under Section 6038, a person is in control of a corporation if they own stock possessing more than 50% of the total combined voting power of all classes of stock entitled to vote.
Okay, so that's the traditional boardroom control I mentioned.
Right. But the second prong is the crucial or. Control also exists if you own more than 50% of the total value of shares of all classes of stock.
Oh, okay.
Yeah.
That second prong is fascinating. Let's play that out for a second. Suppose I'm a U.S. venture capital firm, and I invest heavily in a new tech startup in Germany.
Okay. Pretty common scenario.
And I don't want to run the day-to-day operations, so I explicitly only buy non-voting preferred shares. The founders keep 100% of the voting stock. Legally, I can't vote on a single corporate resolution. I have zero operational control.
Right.
But because my capital injection was so massive, my preferred shares represent 60% of the total monetary value of the entire German company. Am I in control?
In the eyes of the IRS, you are absolutely in control. You're a Category 4 filer.
Oh,
The
yeah.
IRS understands that economic reality dictates behavior just as much as legal voting rights do. I mean, if you hold 60% of the value of an entity, you have immense implicit leverage over how that entity operates, who it does business with, and crucially, at what prices.
That makes a lot of sense. Okay, so that covers direct ownership, whether that's through votes or through value. But as I'm reading through the Treasury regulations here, it seems the rabbit hole goes much, much deeper than just the shares sitting in my specific brokerage account. There's this concept of constructive ownership.
Yeah, constructive ownership is where the compliance nightmare truly begins for a lot of taxpayers. The source material points us directly to the attribution rules under Section 318.
Section 318, got it.
These rules essentially state that the IRS will treat you as owning stock that you do not legally own simply because of your relationship to the person or entity that actually does own it.
Okay, so this is the I don't own it, but my cousin does, so the IRS tags me rule.
Basically, the family attribution rules are incredibly strict. You're treated as owning stock owned by your spouse, your children, your grandchildren, and your parents.
Even if you don't talk to them.
Exactly. There is no escape clause for estranged families or siblings who hate each other. If your spouse owns 51% of a corporation in France, the IRS acts as if you own it too.
That is wild. What about businesses owning businesses? If I don't own the foreign company directly, but say my partnership does?
That introduces what we call upward and downward attribution. So if you're a 50% partner in a domestic partnership, and that partnership owns 100% of a foreign corporation.
The stock is attributed upward to me.
Yes, but it also goes downward. If you personally own stock in a foreign corporation, that ownership can be attributed downward to a partnership you're a part of, suddenly making the partnership itself a constructive owner.
Oh man, let's build a scenario so you listening can really grasp how messy this gets. Imagine we have the Gallagher Family Trust. The trust was set up by a grandfather, and the beneficiaries are his 3 adult grandchildren who all live in the U.S. The trust itself owns a 60% stake in a highly profitable manufacturing plant in Vietnam. The 3 grandchildren don't manage the plant. They don't have direct shares in their own names. They just get a distribution check from the trust every single year.
Sounds nice.
Right. But are those grandchildren Category 4 filers?
So, under the attribution rules of Section 318, stock owned by a trust is considered to be owned proportionately by its beneficiaries. If those 3 grandchildren have equal actuarially determined interests in the trust, they each constructively own 20% of the Vietnamese plant.
Okay, but 20% doesn't cross the 50% threshold for control individually, so they might not be Category 4 filers on their own, right?
Right. Individually, they might be under the radar. However, if they all act together or if there's another entity involved, say they all jointly own a U.S. LLC that acts as a distributor for the Vietnamese plant, the attribution rules can aggregate that ownership.
And the moment that collective constructive ownership crosses 50%.
Exactly. The Category 4 filing requirement is triggered, and Schedule M becomes mandatory.
It's like a corporate version of a genetic test. The IRS is tracing the DNA of the ownership to find the ultimate U.S. beneficiaries.
That's a great way to put it.
And once they establish that you are the Category 4 filer, they don't just want to know about your direct relationship with the foreign sub. Let's look at the structure of Schedule M itself. It's a grid. It has rows for transactions, which we'll get to in a second, but the columns are what really define the scope of this surveillance here.
Yeah, the columns on Schedule M, specifically columns B through F, they force the taxpayer to categorize every single transaction into very specific relationship buckets. Think of it like a casino's eye-in-the-sky security camera.
Oh, I like this.
The casino doesn't just watch the dealer and the player, right? They track the chips moving between the player, the dealer, the pit boss, the cocktail waitress, and the other players at the table to look for collusion.
I love that analogy. It's way better than just thinking of it as a boring corporate org chart.
Yeah.
So let's look at the cameras. Column B is the U.S. person filing the return. That's me, the parent holding the chips.
Right.
Column C tracks transactions with any domestic corporation or partnership controlled by the U.S. person. So these are the domestic sibling companies.
Yep. And then column tracks transactions with any other foreign corporation or partnership controlled by the U.S. person. These are the foreign siblings.
Why do they care about the siblings?
The IRS wants to see if you're moving money laterally between your subsidiaries, perhaps, shifting cash from a high-tax sibling in Germany to a low-tax sibling in the Cayman Islands.
Sneaky.
Yeah.
And then we reach columns E and F, which the source material emphasizes heavily. These columns track transactions with any 10% or more U.S. shareholder of the controlled foreign corporation, or a 10% shareholder of any corporation controlling the foreign corporation.
Yes, the influential cousins.
Why the obsession with a 10% shareholder, though? I mean, a 10% owner can't dictate policy. They can't force the CEO to sign a contract. They don't have that 50% control we just spent all this time defining.
Well, while 50% gives you absolute legal or economic control, a 10% block of voting stock or value gives you something equally dangerous in the eyes of the IRS.
Which is?
Leverage. In the corporate ecosystem, holding 10% of a multinational entity is a massive footprint. It buys you a seat on the board, it buys you the ear of the CEO, and most importantly, it gives you the power to negotiate sweetheart deals that deviate from standard market pricing.
So it ceases to be an arm's-length relationship.
Precisely the phrase the IRS uses. An arm's-length transaction is one where two completely unrelated parties negotiate a fair market price.
Like me buying coffee at a cafe.
Right. The IRS assumes that once you hit 10% ownership, the invisible hand of the free market is no longer the only force guiding the transaction. Let's say an independent U.S. logistics company buys a 12% stake in our U.S. parent company. Okay. Suddenly, that logistics company offers to handle all the global shipping for our foreign subsidiaries at a massive premium like double the market rate.
Wait, why would the foreign subsidiary ever agree to pay double?
Because the logistics company, as a 12% owner of the parent, is exerting its influence. The foreign subsidiary overpays for shipping, which artificially drains profits out of the foreign jurisdiction and hands them directly to the U.S. logistics company.
Oh, wow.
And if the IRS only audited the parent-child relationship, this massive profit shift would be completely invisible. By forcing the U.S. parent to report all transactions with 10% shareholders in columns E and F, the casino's eye in the sky catches the chips being passed under the table to the influential minority owner.
The perimeter they've established is just staggering. I mean, there is literally nowhere to hide the influence. If you have economic ties and more than 10% ownership anywhere in the chain, the IRS demands the receipts.
Yep, they want it all.
So we know who is sitting at the casino table. We've got the parent, the domestic siblings, the foreign siblings, and the influential 10% minority owners. Now we need to look at the rows of Schedule M. What exactly are these related parties passing back and forth?
So the rows are the transactional menu. Treasury Regulation Section 1.6038-2 lays out an exhaustive list of every conceivable way value can be transferred between corporate entities. And it's vital to understand here that the IRS isn't just looking for cash transfers. They are looking for the transfer of economic benefit.
Okay, let's start with the physical, tangible world. The very first lines on the schedule separate the sales and purchases of stock in trade, which is basically just a fancy way of saying inventory, from tangible property other than stock in trade.
Right.
If physical stuff is moving across a border, why does the IRS care if it's inventory or like a piece of equipment?
Because they represent entirely different transfer pricing risk profiles. Inventory stock and trade is your routine, day-to-day business. If you're an apparel company, the IRS expects to see millions of shirts moving from your manufacturing subsidiary in Bangladesh to your distribution hub in California.
Makes sense.
The volume is high, but the profit margin on a single shirt is usually fairly standard. The IRS looks at this line to ensure you aren't artificially inflating the cost of those shirts to leave all the profit in Bangladesh and wipe out your taxable income in California.
It's the sheer volume they're testing. But what about the other tangible property?
That is the capital asset row. That's the machinery, the factory equipment, the server racks. Transactions here are usually infrequent but massive in value. Suppose a U.S. parent company has a fully depreciated but still highly functional robotic assembly line in Detroit.
Okay.
They decide to move operations to Mexico. They transfer that robotic assembly line to their Mexican subsidiary.
And because it's fully depreciated on the U.S. books, its accounting value might be zero. So the U.S. parent just gifts it to the Mexican sub or sells it for like $1.
And that is the exact scenario the IRS is hunting for. If that robotic line could be sold to an independent third party for $10 million, then the U.S. parent just transferred $10 million of raw economic value to a foreign entity without recognizing any taxable gain. By isolating capital assets on a separate row of Schedule M, the IRS can quickly spot when a U.S. company is quietly migrating its high-value physical infrastructure offshore for pennies on the dollar.
Okay, so they're tracking the shirts and they're tracking the machines that make the shirts. But the physical stuff feels almost quaint compared to the next section. Line 3. Sales and purchases of property rights. We're talking about patents, inventions, models, designs, copyrights, trademarks, and secret formulas.
This is the battlefield. Intangible property is where the multi-billion-dollar international tax disputes live. When the IRS commissioner talks about closing the tax gap, this row on Schedule M is ground zero.
Because valuing a secret formula isn't like valuing a shirt. There's no open market for the Coca-Cola recipe or Google's search algorithm.
Exactly the problem. How do you determine the arm's-length price of a completely unique, legally protected, world-changing algorithm?
You can't just check Amazon for the price.
Right. If a U.S. tech company invents a new artificial intelligence model in Silicon Valley, all the future profits generated by that AI should theoretically be taxed in the U.S. But what if the U.S. parent sells the algorithm to a wholly owned subsidiary in a zero tax haven before the product even launches?
The U.S. parent gets to set the price because they control both sides of the transaction. They might say, well, it's just a bunch of untested code right now. We'll sell it to the offshore sub for $1 million.
And then 3 years later, that AI generates $10 billion in pure profit, all of which is now sitting in the zero tax haven, while the U.S. parent only paid tax on that initial $1 million sale.
That's a massive leak.
Exactly. The IRS uses the intangible property rows on Schedule M to build a chronological database. They can track precisely when the U.S. tech giant transferred the patent, to whom, and for how much. When that offshore subsidiary suddenly shows explosive profitability a few years later, the IRS pulls the historical Schedule M, looks at the incredibly low sale price of the algorithm, and retroactively challenges the valuation, demanding billions in back taxes.
It's like a paper trail for the migration of genius. That brings us to services. Compensation for technical, managerial, engineering, or scientific services, and commissions. I imagine a lot of profit can be shifted without moving physical goods or patents at all, just by charging a subsidiary a massive management fee.
The management fee is one of the oldest and most abused tools in the international tax playbook. It's a fantastic way to repatriate cash to a parent company or shift profits to a subsidiary without formally declaring a taxable dividend.
We aren't giving you a share of the profits. We're just charging you $20 million for strategic executive oversight this year.
Exactly. The IRS scrutinizes the services rows on Schedule M relentlessly. The examiner's immediate question is, Did the U.S. parent actually provide $20 million worth of strategic oversight? Show me the emails, show me the flight logs, show me the deliverable reports.
They want the receipts.
Yes. If the U.S. parent is just allocating arbitrary corporate overhead costs to the foreign sub to drain its profitability, the IRS will disallow the expense and recharacterize the transaction, which usually results in a massive tax assessment.
Which flows naturally into the purely financial transactions.
Yeah.
Rents, royalties, dividends, and interest paid and received.
Yeah.
Dividends are obvious. They show how cash is being distributed. Royalties tie back into the intangible property we just talked about. If you don't sell the patent, but instead license it to your foreign sub, the royalty payments show up here.
Right.
But as I dig into the source material, the financial flows that seem the most heavily weaponized by the IRS are the loan lines.
You're looking at lines 31 through 34, accounts receivable, accounts payable, amounts borrowed, and amounts loaned.
And there is a massive trap hiding in the instructions for these lines. The instructions don't just ask for the loan balance at the end of the year. They explicitly demand the maximum loan balance during the year.
This is key.
Why the maximum balance? I mean, if my foreign subsidiary owes me $5 million on January 1st and they pay it back by December 31st, why can't I just report a zero balance? The loan is settled.
You can't report zero because the IRS is hunting for a widespread practice known as window dressing.
Window dressing. Like cleaning your house frantically 15 minutes before the guests arrive, shoving all the clutter into a closet and pretending you live like a minimalist.
That is the perfect analogy. Let's walk through the mechanics of how window dressing works on a corporate scale. Imagine a U.S. parent corporation that is deeply unprofitable. They are bleeding cash.
Okay, not a good spot.
No. To make payroll, to keep the lights on, they continuously borrow money from their highly profitable subsidiary in Ireland. Month after month, the intercompany debt grows. By November, the U.S. parent owes the Irish subsidiary $200 million.
So the U.S. parent is entirely economically dependent on the offshore cash to survive.
Yes. The economic reality is massive intercompany leverage. But the U.S. parent is publicly traded. They have external auditors. They don't want anyone, not the SEC, not their shareholders, and certainly not the IRS, to see a $200 million related party liability sitting on their year-end balance sheet.
Because it looks terrible.
It looks terrible, and it invites questions about why the offshore cash isn't just being repatriated as a taxable dividend.
So they need to clean the house before the December 31st snapshot. How do they do it?
On December 28th, the U.S. parent goes to a massive global bank and takes out an incredibly short-term 3-day bridge loan for $200 million. They take that cash from the external bank and immediately wire it to the Irish subsidiary, paying off the intercompany debt in full.
Okay, so on December 31st, the stroke of midnight, the intercompany loan balance is mathematically zero. The auditors take the snapshot, house looks perfectly clean.
And then on January 2nd, the moment the new tax year begins, the U.S. parent borrows the $200 million right back from the Irish subsidiary and uses it to pay off the external bank's 3-day bridge loan.
The clutter comes right back out of the closet.
The clutter comes right back out of the closet.
That is devious.
Yeah.
If Schedule M only asks for the year-end balance, the IRS would look at line 33, see a zero, and move on.
Okay.
The entire $200 million lifeline would be completely invisible.
Exactly.
Yeah.
By demanding the maximum loan balance during the year, the IRS blows the closet doors off the hinges. They don't care about the December 31st snapshot. They demand to know the highest watermark the debt ever reached.
Wow.
When the U.S. parent is forced to report a maximum balance of $200 million, the IRS immediately recognizes the window dressing. They see the underlying economic reality, that the U.S. parent is using offshore cash as a permanent slush fund without paying the repatriation taxes. The maximum balance requirement is literally a forensic tool designed to pierce the veil of year-end accounting tricks.
That is a brilliant piece of regulatory design. But it's not the only hidden risk in the financial flows. I'm looking at lines 13 and 28. Loan guarantee fees received and loan guarantee fees paid.
Yes.
What exactly is a loan guarantee fee in this context? Because I feel like most people assume you only report things when actual cash moves from one bank account to another.
The loan guarantee fee is one of the most frequently missed items on Schedule M, and it triggers brutal audits under Section 482, the transfer pricing rules. Let's construct a scenario here. Our subsidiary, Techco Ireland, decides to build a massive new data center. They need $1 billion. They go to a third-party global bank to get a commercial loan.
Okay, an independent bank. This isn't an intercompany loan.
Right. But the bank looks at Techco Ireland and says, you're a subsidiary. You don't have a massive credit history of your own. You're a moderate risk. We will lend you the $1 billion, but the interest rate is going to be 8%.
8% on $1 billion. That's $80 million a year, just in interest expense. That crushes the subsidiary's profitability.
Now the U.S. parent company steps into the room. Teco U.S. is a Fortune 50 behemoth with a pristine AAA credit rating. The U.S. parent tells the bank, "We will formally guarantee this loan. If Teco Ireland defaults, we, the parent company, will make you whole."
The bank's risk profile drops to zero. They're basically lending to the AAA parent at that point.
Consequently, the bank lowers the interest rate for Teco Ireland from 8% down to 4%.
Which saves the Irish subsidiary $40 million a year in cash. That is a massive economic windfall.
Here is the critical question the IRS asks. Did the U.S. parent provide a service to this subsidiary?
Well, no cash moved between the parent and the sub. The parent just signed a piece of paper for the bank.
But under transfer pricing principles, the parent provided an incredibly valuable service. They rented out their AAA credit rating. They took on $1 billion of contingent financial risk. If Teco Ireland had gone to an independent insurance company to get a guarantee for that loan,
the insurance company would have charged them millions of dollars in premium fees for that service.
The arm's length standard again? Exactly. The IRS dictates that the U.S. parent must charge the subsidiary an arm's length loan guarantee fee, because if they don't, the U.S. parent is essentially giving away value for free.
And that skews the profits.
Right. This artificially inflates the profits of the Irish subsidiary because their interest expense is $40 million lower, and it artificially depresses the income of the U.S. parent, who is taking on $1 billion of risk without being compensated for it.
So the U.S. parent is legally required to calculate what an independent guarantor would charge, invoice the subsidiary for that amount, and report it on line 13 of Schedule M as a loan guarantee fee received.
And if an IRS examiner looks at a taxpayer's file, sees that a tiny foreign subsidiary has a $1 billion line of credit at prime market rates, but line 13 on Schedule M is blank, it is an immediate, glaring red flag.
They know what's up.
They know a parent guarantee exists, they know the fee wasn't charged, and they will open an audit to impute that income to the U.S. parent, complete with penalties and interest.
It's astounding. Schedule M is essentially a psychological profile of a corporation's tax strategy. It asks every single uncomfortable question, forcing you to quantify influence, value non-cash risk, and expose your year-end accounting tricks.
It leaves no stone unturned.
Which brings us to the operational reality. Because getting all these lines filled out perfectly isn't just about avoiding typos, right? It requires a massive internal apparatus. Let's talk about the traps, the pitfalls, and the practical workflow of actually completing this form.
The single most common and arguably the most dangerous mistake companies make when filling out Schedule M is the netting of transactions.
I see the warning in the Form 5471 instructions. It strictly mandates reporting gross amounts without giving effect to any netting of payments.
The prohibition on netting is absolute. Violating it destroys the fundamental purpose of the form.
Let's use an analogy for you listening. If I look at my personal budget for the month, let's say I buy a high-end laptop for $2,000, but a week later, I return a different television I bought previously, and they refund me $2,000.
Okay.
If my spouse asks how much I spent on electronics this month, I might look at my bank account, see that the balance hasn't changed, and say, I spent zero. It netted out.
And your spouse, much like an IRS examiner, would feel deeply deceived when they finally look at the actual credit card statement and see $4,000 worth of total transactional volume. The volume of activity is the metric that matters.
Let's scale that up to the corporate level. Why does the volume matter so much to the IRS?
Imagine a U.S. parent company, let's call them AutoCo, that manufactures car engines. They sell $500 million worth of engine components to their assembly subsidiary in Germany. In that same year, the U.S. parent buys $490 million worth of finished, assembled cars back from the German subsidiary to sell in the United States.
Okay, $500 million going out, $490 million coming back.
A lazy tax preparer or a company with terrible data systems might look at that and say, okay, we owe them $490, they owe us $500. The net difference is $10 million. Let's just write one intercompany check for $10 million, settle the accounts, and report a $10 million transfer on Schedule M.
If they do that, they just hid $990 million of economic activity from the U.S. government. But again, if the cash settles out, why is the IRS so furious about netting?
Because of the transfer pricing analysis. The legal determination of whether the prices were fair and at arm's length must be applied to each transaction independently. The IRS needs to evaluate the profit margin on the $500 million of engine components, where they overpriced to shift profit to Germany.
Oh, okay.
They also need to separately evaluate the profit margin on the $490 million of finished cars, where they underpriced to shift profit back to the U.S.
I see. It's two distinct events.
It is entirely possible and highly common in abusive structures that the components were massively overpriced and the finished cars were massively underpriced. Both sides of the transaction could be manipulated to dodge taxes in different jurisdictions. If you just report the net $10 million, the IRS cannot see the dual manipulations happening beneath the surface. The margin analysis becomes mathematically impossible. They need the gross amounts to evaluate both sides of the coin.
So no netting. You have to show the ugly, voluminous truth of every dollar that moves. What is the second major pitfall?
Ignoring non-cash transactions. We touched on this slightly with the loan guarantees, where no cash moved but value was transferred. But the trap is much broader. Treasury Regulation Section 1.6038 Kappa-2 requires the reporting of transactions involving non-monetary consideration, or what the code calls less than full consideration.
Non-monetary consideration. Are we talking about corporate barter?
Essentially, yes. Let's say a U.S. parent develops a highly valuable patent for a new chemical process. They want to transfer this patent to their subsidiary in Switzerland. But the Swiss subsidiary doesn't have the $50 million in cash required to buy it at arm's length.
So they don't sell it for cash. What do?
The U.S. parent contributes the patent to the Swiss subsidiary in exchange for more shares of stock in the Swiss company.
So the bank accounts don't change at all. The parent hands over a piece of paper with a patent, and the subsidiary hands back a piece of paper with stock certificates.
And many tax departments, because they rely solely on cash flow reports from their treasury systems, will miss this entirely. They look for wire transfers, see none, and leave the Schedule M line for intangible property completely blank.
But the U.S. parent just transferred a $50 million asset out of the U.S. tax net.
And the regulations require you to report it. You must provide a description of the transaction, an estimate of the fair market value of the property exchanged, and the nature of the non-monetary consideration. You cannot hide behind a lack of bank wires. If value moves, whether through equity swaps, debt forgiveness, or physical barter, it must be quantified and reported.
The sheer administrative burden of tracking that is mind-boggling. Which brings us to the third pitfall mentioned in the sources: cash versus accrual accounting.
Oh, this trips up almost every mid-sized multinational that is filing Schedule M for the first time. The instructions explicitly state that if the corporation uses an accrual method of accounting, which nearly all corporations do for their audited financials, they must use accrued payments and accrued receipts to populate Schedule M. They cannot use cash flows.
Let's break down the mechanics of accrual accounting for anyone who might not be a CPA. Accrual means I record the expense when the legal obligation is incurred, not when the cash actually leaves my checking account.
Correct. Let's go back to Techco Ireland. They license a software platform from the U.S. parent. The contract states Techco Ireland owes $5 million in royalties for the calendar year 2025. Because they use accrual accounting, Techco Ireland records that $5 million expense on their 2025 income statement. They accrue the liability.
But let's say Techco Ireland is facing a liquidity crunch. They don't have the cash on hand, so they just don't pay the invoice. The year 2025 ends, and the $5 million is still sitting in accounts payable. Not a single dollar was wired to the U.S. parent.
When the U.S. tax team sits down in 2026 to file the 2025 Schedule M for Techco Ireland, what number do they put on the royalty line?
Well, if they run a cash report, it shows zero. Yeah. But you're saying they have to put the full $5 million.
They must put the full $5 million. The economic obligation was generated in that tax year. If you only report cash flows on Schedule M, the form will be wildly out of sync with your own financial statements, your audited books, and your tax returns income statement.
The IRS will notice that, right?
Oh, instantly. The IRS cross-references Schedule M with the rest of the tax return. If your income statement shows a $5 million royalty deduction, but your Schedule M shows zero royalty payments to related parties, the automated IRS systems will flag the discrepancy instantly.
Okay, so a tax department has to track gross volumes, absolutely no netting. They have to capture non-cash equity swaps, and they have to base it all on accrued liabilities rather than cash flows. How on earth does a company actually accomplish this? You can't just download a QuickBooks report on April 14th and hope for the best.
You absolutely cannot. The practical workflow required to survive an IRS audit involves the implementation of a continuous, meticulously maintained intercompany transaction matrix.
A matrix. Not a spreadsheet, a matrix.
It is an enterprise-level data system. Every single time a transaction occurs anywhere in the global group, it must be tagged at the source. The system must record who is the buyer, who is the seller, what is their exact relationship under Section 6038? Is it a sibling, a 10% owner? What is the nature of the transaction, tangible goods, IP services? Is it accrued?
And what about currency? This is where my brain starts to melt.
Yeah.
If the U.S. parent operates in dollars, but Teco Ireland operates in euros, and the Japanese subsidiary operates in yen, Schedule M has to be filed in U.S. dollars. How do you translate a year's worth of accrued, unnetted gross volume transactions across 20 different currencies?
The Form 5471 instructions mandate a very specific methodology for this. You must translate the functional currency to U.S. dollars using the average exchange rate for the foreign corporation's tax year, and they require the use of a format called the divide by convention.
Let's slow down and do the math on this. Why the average exchange rate? Why can't I just take the exchange rate on December 31st and apply it to the whole year?
Think about the volatility of foreign exchange markets. Let's say the euro is exceptionally strong against the dollar all year, trading at $1.2 per euro. The Irish subsidiary is doing millions of transactions. Then, in the second week of December, a geopolitical crisis occurs, and the euro crashes to $0.8 per euro.
If I use the December 31st spot rate of 0.8 to translate the entire year's worth of transactions,
you drastically misrepresent the economic reality of the value that actually moved in June and July. The U.S. dollar value reported on Schedule M would be artificially deflated. The average exchange rate smooths out that daily volatility. It provides a standardized metric for converting aggregate volume.
Okay, that makes logical sense. But what is this divide by convention? If I want to convert euros to dollars and the average rate is $1.1 per euro, I just multiply the euros by 1.1, right?
In colloquial math, yes. But the IRS requires the divide by convention to standardize reporting, especially when dealing with currencies that have massive denominations like the Vietnamese dong or the Colombian peso. Under the divide by convention, you must express the exchange rate as the units of foreign currency equal to $1 US and then divide the foreign amount by that rate.
So instead of saying 1 euro equals 1.10 US dollars, you reverse it. You calculate how many euros make up a single US dollar.
Let's do the exact math. If 1 euro is $1.10, then $1 is approximately 0.909 euros. That 0.909 is your divide by rate. If the Irish subsidiary had 10 million euros in gross inventory sales, you don't multiply by 1.10. You take the 10 million euros and divide it by 0.909 to get your US dollar amount for Schedule M.
It achieves the same mathematical result, but it forces a uniform data entry standard across the millions of tax returns the IRS processes.
Exactly. If your internal intercompany matrix isn't programmed to automatically capture gross accruals, identify non-cash swaps, and apply the divide by average exchange rate, your Schedule M is going to be riddled with errors.
And an auditor will spot that immediately.
An IRS examiner will request your internal matrix on day one of an audit. If they map your matrix to your Schedule M and find netting or currency translation errors, the audit immediately escalates from a routine check to a full-blown forensic investigation.
Because if the fundamental data layer is corrupted, the IRS assumes your entire global tax strategy is a house of cards. Which brings us to the real heavy artillery. We've mapped the cast of characters, we've navigated the transactional menu, and we understand the workflow traps. Now let's look at how the IRS weaponizes this data. We're diving into the transfer pricing and BEPS connection.
BEPS, base erosion and profit shifting. This is the overarching focus of both the IRS and the OECD, the Organization for Economic Cooperation and Development.
For you listening, base erosion and profit shifting is exactly what it sounds like. It's the practice of multinational corporations exploiting gaps in tax rules to artificially shift profits to low or no tax locations, where there is little or no economic activity. And simultaneously, they shift massive expenses into high tax jurisdictions, like the U.S., to erode the taxable base.
Schedule M is the primary tripwire for BEPS audits, but it doesn't operate in a vacuum. It is deeply integrated with other schedules on Form 5471. The source material specifically highlights the interplay with Schedule G and the relatively new Schedule G1. Together, these forms create a highly detailed roadmap for an IRS transfer pricing economist.
Let's start with Schedule G. The instructions highlight questions 4B and 4C. These questions track something called base erosion payments under Section 59 Cap A. What qualifies as a base erosion payment?
Section 59 Cap A is a statutory home of the Beat the Base Erosion and Anti-Abuse Tax. The BEAT is a minimum tax specifically designed to punish companies that strip profits out of the U.S.
How do they strip the profits?
Through base erosion payments. Generally speaking, a base erosion payment is any amount paid or accrued by a U.S. taxpayer to a foreign-related party for which the U.S. taxpayer is allowed to take a tax deduction.
Let's apply that. If Techco US pays Techco Ireland $10 million for management services, Techco US gets to deduct that $10 million on its U.S. tax return as a business expense. That deduction lowers their U.S. taxable income. It erodes the U.S. tax base.
That is a classic base erosion payment. It also includes payments for reinsurance premiums or payments to acquire depreciable property from a foreign affiliate.
So Schedule G, questions 4B and 4C ask the taxpayer point blank, did you make these payments?
Yes. And if you check the yes box on Schedule G, the IRS computer systems immediately cross-reference that qualitative answer with the quantitative data on Schedule M. They look at the services line, the royalty line, the tangible property line. They want to see the exact unnetted dollar amount of the base erosion. Schedule M provides the ammunition for the IRS to calculate exactly how much you owe under the BEAT minimum tax.
Wow, the forms literally talk to each other.
They do. But the most complex, high-stakes connection is between Schedule M and Schedule G1. Schedule G1 is entirely dedicated to cost-sharing arrangements, or CSAs.
Cost-sharing arrangements. I've read that this is where the truly astronomical tax disputes live. We're talking cases involving companies like Amazon and Apple fighting the IRS over billions. Let's do a deep dive here. The source material mentions tracking platform contribution transactions, PCTs, and cost-sharing transactions, CSTs. What exactly is a cost-sharing arrangement conceptually?
Let's build a long-term scenario to understand the mechanics. Imagine PharmaCorp US wants to develop a revolutionary new cancer drug. The research and development phase is going to take 5 years and cost $2 billion. If the drug is successful, the global patents will be worth tens of billions.
If PharmaCorp US develops it entirely in New Jersey, they bear the full $2 billion cost, but all the future global profits will be taxed at the U.S. corporate rate,
which they aggressively want to avoid. So PharmaCorp US enters into a cost-sharing arrangement with their wholly owned manufacturing subsidiary in a lower tax jurisdiction, let's say PharmaCorp Singapore. They agree to share the ongoing costs of developing the drug. They run a complex economic analysis and determine that if the drug is successful, PharmaCorp US will keep the rights to sell it in North America, which represents 60% of the anticipated global market. PharmaCorp Singapore will get the rights to sell it in the rest of the world, representing 40% of the market.
Okay, so the anticipated benefits are split 60-40.
This is the critical metric in the regulations. It's called the RAD share, the reasonably anticipated benefits share. Because PharmaCorp Singapore expects 40% of the future benefits, they must pay for 40% of the ongoing intangible development costs, the IDCs.
So over the 5 years, as PharmaCorp US burns through the $2 billion R&D budget running clinical trials, PharmaCorp Singapore has to reimburse them for 40% of those costs. Singapore has to write checks totaling $800 million.
Yes. Those ongoing reimbursement payments for the clinical trials and the lab work are called cost-sharing transactions, or CSTs.
And let me guess, the IRS demands to see those CST payments on Schedule M.
They do. Schedule M, lines 5 and 20, are specifically designated for reporting cost-sharing transaction payments received and paid. But the IRS knows that companies rarely start a multi-billion-dollar R&D project from absolute scratch.
Right. PharmaCorp US didn't just walk into an empty lab. They probably already had a foundational base molecule or a massive database of prior genetic research that they brought to the table to kickstart the new cancer drug project.
Exactly. And PharmaCorp Singapore didn't pay to develop that foundational base molecule. So PharmaCorp Singapore cannot just jump into the cost-sharing arrangement, pay for the ongoing clinical trials, and claim 40% of the final patent without paying for the head start.
They have to buy into the existing technology.
The regulations call that pre-existing technology a platform contribution. And the payment PharmaCorp Singapore must make to PharmaCorp US for the right to use that pre-existing technology is called a platform contribution transaction, or a PCT.
The buy-in payment. And where does a PCT get reported?
Schedule M, lines 4 and 19. Platform contribution transaction payments received and paid. Now, put yourself in the shoes of an IRS transfer pricing economist. You open the Pharmacore Form 5471. You look at Schedule G1 and see that Pharmacore Singapore has a 40% RIB share of a massive new blockbuster drug project. You look at Schedule M, line 5, and see the CST payments. Singapore is paying its 40% share of the ongoing clinical trials. Everything looks mathematically aligned.
But then
The economist looks at Schedule M, line 4, the PCT buy-in payment, the payment for the incredibly valuable foundational base molecule, and the U.S. parent only charged Pharmacore Singapore $1 million for it.
a completely artificially deflated price.
The trap snaps shut. The IRS knows immediately that Pharmacore US essentially gave away a highly valuable foundational asset to an offshore subsidiary for a bargain basement price. By underpricing the PCT, Pharmacore US shifted massive future profitability to Singapore without recognizing the taxable income in the US today.
Schedule M and Schedule G1 work together as the ultimate diagnostic tool. They expose the mathematical contradiction.
The U.S. parent might have a 500-page, beautifully bound transfer pricing master file sitting on their desk filled with economic theories and functional analyses arguing that their pricing is fair. But the IRS doesn't read the 500-page narrative first. They look at the raw data on Schedule M.
Schedule M is the undeniable quantitative truth of what actually happened. It is the executive summary.
And if your beautifully written transfer pricing narrative says one thing, perhaps arguing that the foreign subsidiary assumes all the entrepreneurial risk and therefore deserves all the profit, but your Schedule M gross payments show the U.S. parent performing all the high-value R&D, receiving zero royalties, and guaranteeing all the subsidiary's bank loans. You have drawn a massive target on your own back. The IRS will take the raw data from your own Schedule M and use it to completely dismantle your 500-page transfer pricing narrative.
That is terrifying. If the narrative doesn't perfectly match the matrix, the whole defense collapses. And if your defense collapses, or worse, if you simply fail to file these incredibly complex schedules because the data gathering is too overwhelming, the IRS brings out the heavy artillery.
Let's talk about the stakes, penalties, and enforcement.
The penalty regime for Form 5471 is designed to be punishing. The IRS cannot police the global tax system without this data, so they make the cost of withholding it catastrophic.
I'm looking at the initial penalty provisions under Section 6038, subsection A. It starts with a $10,000 initial penalty. A $10,000 penalty is imposed for each annual accounting period for each foreign corporation for the failure to furnish the required information within the time prescribed.
Okay, $10,000. For a mid-sized company with a few subsidiaries, that stings. But for a massive Fortune 100 multinational with 300 foreign subsidiaries, they file the forms late. The IRS assesses a $3 million penalty across the group. The CFO might look at that and say, you know what? Implementing the enterprise data matrix to track gross unnetted accruals will cost us $10 million in IT and consulting fees. Let's just eat the $3 million penalty. It's cheaper. It's a cost of doing business.
And historically, you are absolutely right. Many multinationals viewed the statutory monetary penalty as a mere nuisance fee, not a deterrent. But the IRS anticipated that exact cost-benefit analysis. The Section 6038 penalty doesn't stop at $10,000. If the information isn't filed within 90 days after the IRS mails you a notice of the failure, an additional $10,000 penalty is charged for every 30-day period the failure continues, up to a maximum of $50,000, so a maximum of $60,000 per entity. Even still, for a whale of a corporation, $60,000 per subsidiary might still be viewed as cheaper than compliance.
Which is why Congress and the IRS built in the hidden hammer. The monetary penalty is just the opening salvo. The true danger lies in the foreign tax credit reduction.
The hidden hammer. This is what we talked about at the very beginning of the deep dive. The speeding ticket that takes 10% of your life savings. Let's walk you the math of how this actually works.
Under Section 6038, subsection C, if a taxpayer fails to file or report all the required information, which includes leaving lines blank or netting numbers that shouldn't be netted, they are subject to a mandatory 10% reduction of the foreign taxes available for credit under Sections 901 and 960. For you listening, foreign tax credits are the lifeblood of multinational tax planning. They are the mechanism that prevents double taxation. If a U.S. corporation earns $100 million in Germany and pays $25 million in corporate tax to the German government, the U.S. government doesn't want to tax that same $100 million again at the full U.S. rate. So the U.S. grants a $25 million credit. The U.S. parent uses that credit to offset their U.S. tax bill dollar for dollar.
Exactly. Foreign tax credits are as good as hard cash to a multinational. Now imagine a massive global conglomerate. They operate in 50 countries, they pay billions in foreign taxes. In a given year, they might have $2 billion in foreign tax credits sitting on their U.S. tax return.
$2 billion of pure tax offset.
The tax director of this conglomerate decides that gathering the maximum loan balances for Schedule M for a complicated joint venture in Brazil is too difficult. So they leave the line blank. They file a substantially incomplete Form 5471.
The IRS computer flags it.
The IRS sends a notice. 90 days pass. The U.S. parent ignores it or fails to provide the data. The IRS then invokes Section 6038, subsection C. They unilaterally reduce the conglomerate's total global foreign tax credits by 10%.
10% of $2 billion is $200 million.
$200 million. That $60,000 nuisance penalty just evaporated into insignificance. The U.S. parent's tax bill just skyrocketed by $200 million in hard cash simply because they failed to report the correct loan balance on an informational schedule.
And it scales, doesn't it? The punishment keeps growing.
The instructions dictate that if the failure continues 90 days after the IRS notice, an additional 5% reduction is applied for each 3-month period the failure continues. Theoretically, you could wipe out your entire ability to claim foreign tax credits globally. It is an utterly draconian penalty, intentionally designed to ensure absolute, unquestioning compliance from the largest corporations on Earth.
But surely the law recognizes reality. What if it's literally impossible to get the data? What if the foreign subsidiary's server farm burned down in a fire? Or what if you are a minority 15% U.S. shareholder, you are required to file Schedule M to report your influence, but the hostile foreign majority owners refuse to give you access to the internal accounting systems? Does the IRS still hit you with the $200 million hammer?
There are relief mechanisms, but they are highly structured. First, there is a reasonable cause defense. If you can demonstrate to the satisfaction of the IRS that the failure to comply was due to reasonable cause and you acted in good faith, the penalty might be waived. But reasonable cause is a high bar. You can't just claim ignorance or say it was too expensive to gather the data.
What about the hostile majority owner scenario, where you literally cannot force them to give you the unnetted transaction data?
For that, the IRS introduced Revenue Procedure 2019-40, which provides a lifeline known as alternative information.
How does alternative information work?
The primary requirement for Schedule M is that the data must be prepared in accordance with U.S. Generally Accepted Accounting Principles, U.S. GAAP, and U.S. tax law. That requires a massive accounting conversion if the foreign sub keeps its books in local statutory accounting. If that precise U.S. GAAP data is genuinely not readily available, such as in the minority shareholder scenario you described, RevProc 2019-40 allows the taxpayer to use alternative data.
Like what?
You can use the audited local statutory financial statements of the foreign corporation. If those aren't available, you can step down to unaudited local financials, provided they are the records regularly maintained by the corporation.
But you have to explicitly tell the IRS you are doing this. You can't just slip local accounting data into the form and hope they don't notice.
Precisely the opposite. You must check a specific box on page 1 of Form 5471, Item F, and enter a designated code. This code alerts the IRS examiner that the data on Schedule M is based on alternative information. It's a flag that says, "We did our best, but this data hasn't been scrubbed through U.S. GAAP standards." It protects you from the massive penalties for filing an inaccurate form, provided you meet the strict criteria of the revenue procedure.
It's a necessary pressure release valve for an incredibly strict system. And you listening need to understand that the IRS isn't policing this by hand anymore. The days of an IRS agent sitting in a basement in Ogden, Utah, manually reviewing a paper, Form 5471, are long gone. The source material explicitly references Form 8278, Assessment and Abatement of Miscellaneous Civil Penalties.
Yes, accompanied by specific penalty reference numbers, or PRNs, PRN 625 and PRN 676.
What do those reference numbers actually mean in practice?
They mean the enforcement is automated. The IRS has digitized the intake of these forms. If their computer systems detect a late-filed corporate return, and that return has a Form 5471 attached to it, the system can automatically trigger Form 8278. It systemically asserts the $10,000 initial penalty and generates the notice letter without a human examiner ever having to touch the file. It triggers a cascade of automated deadlines that the taxpayer must fight to abate.
We have covered an immense landscape today. To recap the journey for you, we started by defining the cast of characters, realizing that the IRS uses the concepts of voting power, economic value, and the incredibly complex Section 318 attribution rules to cast a net that catches not just parent companies, but sister entities, trusts, and influential 10% minority shareholders.
We then mapped out the transactional menu of Schedule M itself. We saw how the IRS isolates routine inventory from the high-stakes transfers of fully depreciated capital assets. We explored the valuation nightmares of intangible property and the forensic hunt for window dressing through the maximum loan balance requirement.
We discussed the hidden transfer pricing risks of parent-backed loan guarantees, and we navigated the absolute prohibitions on netting transactions, the mandate to report non-cash corporate barter, and the necessity of using accrued liabilities rather than cash flows. And we did the math on the divide by convention to see how a continuous intercompany matrix is the only way to survive the currency translation workflow.
All of which leads to the realization that Schedule M is the ultimate quantitative executive summary for transfer pricing and beat audits, linking directly to base erosion payments on Schedule G and exposing artificially deflated PCT buy-in payments for cost-sharing arrangements on Schedule G1.
And finally, we looked at the stakes, the automated $10,000 initial penalties, and the catastrophic, globally scaling hidden hammer of the foreign tax credit reduction under Section 6038, subsection C, which can cost multinationals hundreds of millions of dollars for failing to provide this unnetted data.
It fundamentally changes how you view a simple tax form. It isn't just compliance paperwork. It is a transparency engine.
It is a transparency engine. But before we sign off, I was reading very closely through the absolute end of the Form 5471 instructions in our source stack, and there was something hiding in the newest revisions, something that suggests this American transparency engine is about to be plugged into a much, much larger machine.
You are referring to the new additions to Schedule G.
Yes. For decades, Schedule M and Form 5471 have been tools used exclusively by the United States IRS to protect the United States tax base. But the instructions now feature reporting lines for the income inclusion rule, the qualified domestic minimum top-up tax, and the UTPR.
The IIR, the QDMTT, and the undertaxed profits rule.
For those of you listening who follow global macroeconomics or international tax news, you recognize those acronyms instantly. Those are the specific legal mechanisms of the OECD's Pillar 2 Global Minimum Tax. Over 130 countries around the world have agreed to implement a coordinated 15% global minimum tax on massive multinationals. It is, without exaggeration, the biggest shift in international taxation in a century.
And Pillar 2 requires an unprecedented, historically unimaginable level of jurisdictional data sharing and profitability analysis to calculate where the top-up taxes are owed.
Which leaves us with this final, provocative thought to mull over. For decades, the incredibly detailed, unnetted, gross volume-related party data you mapped out on Schedule M was a private, highly guarded conversation between your corporation and the IRS. It was a way for the U.S. government to X-ray your corporate structure. But as the world moves to a unified global minimum tax, requiring massive data exchange between sovereign nations to enforce these new rules, will the incredibly detailed blueprint you draw today on Schedule M become the exact map that foreign governments in Europe, Asia, and South America use to audit your global tax rate tomorrow? Is the IRS's X-ray machine about to be shared with the entire world?
It raises a profound question about corporate data privacy, the sharing of proprietary transfer pricing models, and the future of global tax enforcement. The perimeter of the audit is no longer just the U.S. border.
It really isn't. Thank you for joining us on this deep dive. If you work in this field, I highly encourage you to go review your intercompany matrices, double-check those maximum loan balances to ensure you aren't accidentally window dressing, and keep digging into the data. Until next time.